Today, uncomfortable highs and wonky data says brace, brace, brace. Hello again, it's Martin North from Digital Finance Analytics, well, that is post covering finance and property news. In this week's market update, as normal, we're going to start in the US, across to Europe, Asia, and in Australia, and also cover the key points for oil, gold, and crypto. My aim is to try and integrate the main themes of the week and also point forward to what may happen next. Now, there were a few main themes. First, some key markets are touching all-time highs, even if on Friday, many markets took a breather, driven by profit-taking after a week of record-setting advances, which, by the way, were fueled by a series of dovish central bank signals. The US dollar struggled to extend a gain as US yields ticked lower, but central banks are still watching for greater certainty on inflation trends, and there is building speculation that the neutral interest rate is actually going to be higher than expected. In addition, the fuzziness in the data flows continue. That's a problem for central bankers who want to be data dependent, perhaps even too data dependent. The US Central Bank sharply upgraded its outlook for growth in 2024, and Thursday's data suggested the US economy remains on solid footing after the number of Americans filing new claims for unemployment benefits unexpectedly fell last week, while sales of previously owned homes increased by the most in a year in February. All this suggests the Fed doesn't need to be in a hurry to cut rates going forward. 314 Research Warren Pies said the Fed wants a soft landing. A recession isn't imminent. Inflation data will cooperate in the short term. Investors have been too slow to embrace the bull market, and all this is how you end up with an epic melt up. But stocks are approaching levels that finally make us uncomfortable. So where to from here? And amid the debate over the outlook for US equities is rising expectations stoked by central bankers this week that a global pivot to rate cuts is near. The Swiss National Bank cut a quarter point this week, and Goldman Sachs said it expected the Federal Reserve, as well as the European Central Bank, the Bank of England, and the Bank of Canada to begin cutting rates in June. On Wednesday, the Federal Reserve left the Fed funds rate alone at 5.25 to 5.5%, but it did indicate that it was still prepared to lower rates by 75 basis points this year, despite a worrying uptick in US inflation and economic growth solid enough to maybe even dodge a soft landing. Traders now see a 66% chance of the first rate cut hitting in June from 55% a week ago, according to the FedWatch tool. The MSCI World Equity Index fell 0.26%, but it was still up 1.8% since last Friday. That's the biggest weekly gain this year. Shares in New York closed mixed, with the Dow and the S&P 500 ending lower, while the Nasdaq Composite edged higher. The S&P 500 on Friday fell 0.1% to 5,234. The Dow fell 0.77%, aided by a near 7% drop in Nike, and the Nasdaq Composite gained 0.16% to a record high of 16,428. For the week, they rallied 2.3%, 2%, and 2.9% respectively. The S&P 500 closed less than 30 points shy of the record high that it set earlier in the week, and it advanced nearly 33% over the past 12 months, with many Wall Street analysts rushing to lift their year-end targets. Though rallies in stocks such as Nvidia and Meta Platforms have been the market's main individual drivers into 2024, the financials, industrials, and energy sectors are now also outperforming the S&P 500's 9.7% year-to-date gain. And that has eased worries that the markets are still becoming increasingly tied to the fortunes of a small group of stocks. Well, maybe. After the Magnificent Seven all posted huge gains in 2023, performance among them has diverged this year, giving investors another reason to look at the rest of the market. Enthusiasm over artificial intelligence helped fuel the 90% gain in the shares of Nvidia so far this year, while Microsoft gained 14.5%. On the other side of the ledger, Apple and Tesla are down about 11 and 32% respectively for the year. The latest blow for Apple came this week when the Department of Justice alleged the iPhone maker monopolized the smartphone market, highlighting the regulatory risk that could make investors wary of big tech. Nike sank 7% after the sportswear retailer issued a warning for a decline in first half revenue as it looks to ramp up innovation efforts amid competition from upstarts including On and Hoka. Amid all of this, some corners of the market, such as small caps, still look subdued. The Russell 2000, which is focused on smaller companies, is only up 2.2% year to date. But Tim Hayes, chief of global investment strategist at Ned Davis Research, said optimism is excessive and tailwinds are fading. The 1 year cycle, the 4 year cycle, and the extremely optimistic sentiment are warnings of weakness, much as they were ahead of the August to October correction. But what we haven't seen is the kind of breadth deterioration evident last August when the correction was getting underway. And it seems that investors are indeed starting to shift money out of the US. TD Securities wrote, following record-breaking inflows last week, global equity flows reversed with outflows of $21 billion US. Again, the playbook was US denominated, with the region recording the largest weekly outflows since December 2022, totaling $22 billion. This perhaps indicates some profit taking on the back of a broad-based bull run across the US equity market, with the S&P 500 continuing to reach new highs. That said, Yanadi Research said it's holding its S&P 500 target for now. Rather than raising our target for the year end, we are raising our expectations for what the bull market could deliver through the end of 2024 and beyond. We think that 5,400 is achievable by the end of next year. If that happens, then 5,800 would be our target for the end of 2025. In other words, we think that the bull market has staying power. Investors in the coming weeks will be watching Friday's personal consumption expenditures price index that will offer the latest read on inflation. And the end of the first quarter could also prompt some volatility as fund managers adjust their portfolios. The yield on benchmark US 10-year notes fell on Friday to 4.199%, while the 2-year note yield, which typically moves in step with interest rate expectations, fell to 4.595%. The dollar index gained 0.4%, on track for its best week since the first week of the year, because markets are now accepting that other major central banks will reduce their policy rate faster than the Fed, thanks to the further evidence from the strong economic data that we've had out of the US this week, if you can believe it. The US crude futures settled down 0.31% at $80.80 a barrel, and Brent futures for oil fell 0.26% to $85.57 per barrel. The possibility of a ceasefire in Gaza weighed on prices, along with the stronger dollar and lower US gasoline demand. Spot gold fell 0.73% to $2,164 an ounce, but was near a record high set on Thursday. And US gold futures fell 0.83% to $2,166 an ounce. Investment flows into gold in the week to Wednesday reached their highest in almost a year, according to Bank of America Global Research. Over in Europe, the Stoxx 600 fell 0.03% after touching a new all-time high, while the French and German indices also notched up record highs. Even London's FTSE 100 played catch-up, rising 0.6%, helped by expectations that the Bank of England would cut rates sooner than previously thought. The governor, Andrew Bailey, told the Financial Times that the expectation of more interest rate cuts this year, on a whole, was not unreasonable. And 2 MPC members dropped their calls for a rate hike in the face of easing inflation. The British pound weakened 0.44% to $1.26, having earlier hit a 1-month low despite stronger than expected retail sales figures. And UK inflation dropped to 3.4% in February, with further declines expected in coming months unless services and energy costs rise again, and a swathe of price increases from 1 April will slow potentially the fall. In more jaw-boning, the probability of a European Central Bank rate cut before summer is increasing, Bundesbank President Joachim Nagel said. The comments adds Nagel to a long list of policymakers seemingly backing a cut in June and suggesting the ECB will be the second major central bank after its Swiss counterpart to start unwinding a record string of rate hikes. Eurozone government bond yields declined. The benchmark German 10-year yield was down to 2.319%, while the euro was down 0.49% to $1.0807. In Asia, China's yuan dropped sharply during Asian trade, hitting a 4-month low, in a move that analysts attributed to rising expectations that there will be more monetary easing to prop up the country's economy. Concurrently, local media reports said that the Chinese government officials had met with mainland mutual fund operators in a bid to increase Beijing's supervision of the firms, and also renewed efforts by US lawmakers in the House of Representatives to restrict investments by US mutual funds in certain Chinese entities. The offshore yuan was priced at 7.2295 per dollar. The sudden move knocked the Shanghai Composite Price Index down 0.95%, and MSCI's broadest index of Asia-Pacific shares outside Japan fell 1.1%, while Japan's Nikkei rose 0.18% to a record high close. China's Shanghai Shenzhen's CSI 300 and Shanghai Composite indices slid on Friday and were among the worst performers in Asia. Losses in technology and mainland stocks dragged the Hong Kong Hang Seng Index down by nearly 2%. Chinese technology stocks were battered by those fears of more US sanctions after a top Commerce Department official suggested that SMIC, the country's biggest chip maker, may have violated US trade law in making a processor for a flagship Huawei phone. SMIC, formerly known as Semiconductor Manufacturing International Corp., slid over 5% in Hong Kong trade, with losses in the chip maker spilling over into the broader technology stocks. The US dollar has whipsawed this week, initially coming under pressure from a somewhat more dovish than anticipated Fed meeting before reversing sharply higher. The first clue for another leg higher actually came in on Tuesday after markets were unimpressed with the Bank of Japan's tentative steps to fully exit from its stimulus policies. US exceptionalism may keep the dollar well bid for a little while longer, giving currencies such as the yen little chance of a comeback. The yen slump prompted Japan's finance minister to warn that they were watching foreign exchange moves with a high sense of urgency. That helped the Japanese currency to stabilize at around 151.50 per dollar. Japan's Nikkei 225 index was flat on Friday after briefly rising as much as 1% to a record high above 41,000 points, but gains in the Nikkei were short-lived as data showed that Japanese consumer price inflation grew sharply in February. The reading came just days after a historic interest rate hike from the Bank of Japan and led further credence to the Bank of Japan's hawkish long-term outlook. Analysts at Citi said that the Nikkei was likely to remain range-bound around 41,000 points amid a dearth of immediate catalysts for a push higher, as well as an eventual tightening in policy by the Bank of Japan. Broader Asian markets retreated. Losses in heavyweight technology stocks pulled South Korea's Kospi 0.4% lower, while India's Nifty 50 index rose 0.2% and remained above 22,000 after making a strong rebound in the prior session. In Australia, the S&P ASX 200 fell by 0.2% or 11 points to 7,770 at the closing bell, weighed down by a sell-off in the commodity-related sectors. The benchmark still sealed a weekly gain, though, of 1.3% after a busy 5 days of central bank meetings. On the ASX, energy stocks tracked a lower oil price to fall 1.3%. Woodside Energy fell 1.8% to $29.73, and Ampol declined 0.8% to $40.29. The materials sector slipped 0.9% as Singapore iron ore futures fell 3.1% to $106.40 a ton on the April contract. That sent BHP down 0.8% to $40.29, and Fortescue Metals off 2.1% to $24.64. ANZ analysts wrote a report saying that the iron ore price may be nearing a floor amid a reset in expectations around demand, but we'll see about that. Gold stocks were among the worst performers on Friday in a bout of profit-taking. Bellevue Gold dropped 5.3% to 1.885, and Genesis Minerals lost 6.3% to $1.80. In corporate news, Fisher & Paykel Healthcare rallied 7.7% to 24.18 and was the best performing stock on the ASX 200 after the company upgraded its full-year earnings guidance. It's worth noting, though, that overall, the ASX 200, excluding resources, currently trades at 18.5 times forward earnings, which is 40% above its long-run average of 13.5 times and 12% above the previous peak in May 2007, which was just before the global financial crisis. And no, this is not just about Commonwealth Bank being at record highs. The median stock on the ASX is also trading at a PE multiple well above its long-term average. So what gives? Well, at the same time as valuations have shot up, the equity risk premium, that is, the compensation an investor gets for owning equities over the risk-free bond yields, for which the 10-year government bond rate is a good proxy, has shrunk, even as interest rates and bond yields have moved higher. Analysts suggest this pricing is explained by the market expectations of rate cuts coming, which would, of course, drive earnings higher. But if this is delayed or China trade goes off the boil, then Australian equities appear well owned, truly overvalued, and set for a correction. And we'll see about that. In crypto land, Bitcoin's price action is currently under the influence of US spot Bitcoin exchange traded funds and the highly anticipated rewards halving event. This upcoming halving is particularly unique due to it being the first to follow an ETF-led rally in Bitcoin's history. Typically, the effects of reduced mining rewards on Bitcoin's price are observed roughly 6 months post-halving. Yet, with all this new backdrop of prior ETF-induced growth, predictions are more speculative, navigating through uncharted territories. But expect to see major shifts within the Bitcoin mining industry. The future direction of Bitcoin's value could either establish a new price equilibrium, supporting miners amidst their hefty energy costs, or it might trigger a sell-off to maintain operational liquidity. So some are saying if miners can leverage their holdings without direct selling, Bitcoin's price could still soar to 100,000 US in 2024, echoing a widespread sentiment among asset managers and industry pundits. On the flip side, though, a less favorable condition could see Bitcoin retest support levels around 40,000 US, particularly if mining facilities are forced to liquidate assets for operational funding. In a Friday discussion at the Bitcoin Investor Day in New York, Mike Novogratz, the CEO of Galaxy Digital, shared insights on why he thinks Bitcoin, though, is likely to continue trending higher. Highlighting concerns over government spending and borrowing, he said that Bitcoin is benefiting from US fiscal indiscipline. What's the macro story for Bitcoin? He said, it's relatively simple. Our government can't keep its pants on and stop spending money. That went from a problem in the early 2000s to a crisis with Donald Trump and Joe Biden. They go down as the two presidents who destroyed our fiscal stability, he said. With national debt surpassing $34 trillion and the government spending reaching 25% of GDP, the cryptocurrency, according to Novogratz, stands as a safe haven against potential inflation and debt debasement. This viewpoint aligns with growing investor interest in Bitcoin as a hedge against fiscal uncertainty. And of course, he's a long-time Bitcoin enthusiast since his early days and noted the spike in government expenditure during the Trump and Biden administrations, emphasizing the normalization of structural deficits. Until you see a government, both Dems and Republicans, that says enough, Bitcoin's going to keep going higher, he said. Anyway, Bitcoin fell a little bit in the past 24 hours and is sitting at 64,591 at the time of writing. So standing back, we have mega peaks pretty much wherever you look. But the underlying data is getting very fuzzy, and markets are quite overvalued, particularly in the US and in Australia. And of course, the China story continues to degrade. So the bottom line is this: there is still significant uncertainty about the direction of rate cuts, despite what some are saying, and the markets are overvalued. Therefore, as I said at the start, maybe it's time to just brace and see what happens, because we are getting pretty toppy, and actually the data really doesn't support it. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.